it up from here. Let's go straight into the pits for our market roundup. We have Doreen Mogavero at the New York Stock Exchange, and Larry Shover is back in Chicago. Doreen, let me start with you. How did you interpret today's action in the S&P?
Well, I think, listen, nobody's really doing much. We've got very, very low volumes here. Everyone's waiting to see what is going to be said by Mr. Bernanke tomorrow. You know, we've got a lot of news this week, and we've got jobless claims at the end of the week. So I think that's really going to be the focus. I think that today really was a carryover from Friday, and insofar as Friday was really a lot of short covering. There wasn't much real substance to that rally, and I think people are just waiting to see what's going to happen tomorrow with Mr. Bernanke.
Larry, let me bring you in here. Would you attribute the recent move then to short covering as well, or do you think there's something else at work here?
There is something else at work. I mean, the broader narrative is that we're at a stalemate right now, but behind all this, we have some huge plates moving in the right direction. I mean, U.S. housing, I think we're bottoming out, and that's what all the reports say. I think we're underestimating the tailwind that that's going to provide. I mean, Europe, let's not get it wrong. I mean, it's not going to be linear. It's not going to be short, but they are moving in the right direction. And even though China was down almost 2% yesterday, they had a slew of great numbers come out just last week. I mean, all that's running behind the scenes. I mean, when you consider how much China was down yesterday, how bad retail sales was this morning, the S&P's held up pretty well.
So if all that is in fact the case, what's going to move this market higher?
I think what's going to move this market is something that's going to either come out of Europe, that's going to be a defining roadmap. And people know that there's a difference between what's credible and what's doable. And then what Ben's going to say, is he going to make a move for August, or is it going to be September? I mean, I think the options markets are implying something in between. If he comes out and says we're maybe going to do something in September, that's actually pretty hawkish. So let's hope it's going to be August to get these markets going again.
Hey, Doreen Mogavero, a number of portfolio managers come on our air and say no way can the chairman do anything with rates or anything else for that matter so close to an election. What's your call?
Oh, I think there's a lot of people that would like to see him raise them, even if it's just a little bit. I don't think
rates.
Raise
not
rates,
lower, but raise
not
rates.
Not lower, but raise rates. I don't think that's going to happen. I don't think anything's going to happen, quite frankly, in the rate department. I think he's pretty well locked in. The best I think we can hope for, as I think Larry has insinuated, is that he's going to do something in August to extend, you know, whatever his monetary policy's been. So I think that, but I don't think that's going to happen, and I don't think most traders think that's going to happen either.
All right, Larry, let me bring you into second quarter earnings. We have a lot of tech names now starting to filter in this week. IBM, Intel, Microsoft. What are you expecting? Because we've seen a lot of lowered forecasts across all subsectors of tech right now.
Yeah, and obviously it's going to be a huge week, and one reason why we haven't done much in the market today. But let's keep in mind that, as you said, the guidance has been lowered and walked down so quickly. I do believe that more than 60, maybe 65% of earnings will beat estimates, and that's going to be a huge boon to the market. Another reason why we're holding up in the S&P is around 1340, a very key support area.
Hey, Larry Shover, hold that thought. We got some breaking news. About a fifth of the companies in the S&P 500 are reporting, one-third of which, by the way, are financials. Goldman Sachs on deck tomorrow morning. So shares down about 25% over the past year, significantly trailing the broader market. The question is, do you buy it here? Well, here to answer that question, 3 versus AJ, David Conrad talking fundamentals, Katie Stockton on the charts, and Larry Shover with the options trade. All right, David, you're on fundamentals. Let's start with you. Give us a rundown, your take on Goldman.
We think it's a pretty good risk-reward right here. I mean, the summer months are certainly hard to go along the brokerage stocks, and we don't think this quarter's a huge catalyst, although we are a little bit encouraged after JPM and Citi's numbers. But you have a stock here that's de-risked the balance sheet, and they're really the only universal bank that's buying back their own stock right here. So it feels to me like there's a bit of a floor in the stock, and it's a call option if you hear any good news out of Europe.
Yeah, maybe a call option on upside. Last quarter, they earned $3.92. This quarter, the average estimate's about, what, $1.18. I mean,
right.
What drives it down practically 70%?
Yeah, well, I think we're seeing that across the board. I mean, one thing you're seeing, investing in lending, having negative markets. The market was down this quarter. Credit spreads widened, so that's kind of a headwind there. And also trading environment volumes was down. They're still doing very well in investment banking and #1 in M&A.
Sounds like a perfect storm other than M&A, which is going pretty well. Katie Stockton, let me ask you, you pore over charts. Day in, day out, month in, month out. Goldman Sachs, you probably know this one in your sleep. How's it strike you?
Well, it also looks compelling to me from a risk-reward standpoint. Like David said, it does seem to have a floor underneath the price. It held support at its late 2011 lows recently in June, at the same time becoming very oversold from an intermediate-term perspective. In fact, it's still quite oversold here, even as it breaks out above its 50-day moving average on improved short-term momentum. So I think there's a good deal of upside for Goldman Sachs and many of its peers in the large-cap financial space.
Okay, we're looking at that blue line down there is, call it $90, which has certainly been a floor of support. Longer term, if you were to look at like a 5-year chart, there's a downward sloping trend line. In theory, the top of that line is 140, which means maybe you get some upside. But anything that would change that longer term downtrend?
Well, to me, it looks like it's undergoing a long-term reversal in that there could be what we call a double bottom formation on the chart going back several years. So this double bottom is not complete. It's actually far from it. We would need a move above the 200-day moving average, which I would consider to be next resistance on the chart, and that's around 104.5. And I think that's good upside from current levels, and a breakout would suggest even greater upside.
All right, so two moderately bullish views, fundamental and technical. All right, Larry Shover, Mr. Options Guy out in Chicago, wrap it into a trade for us, assuming that you too are moderately bullish.
I'm not moderately bullish. I think it's going absolutely nowhere right now. When you have over half of analysts saying, hold the stock, to me, that's code for I don't know what's going to happen. So I'm looking at a 4-day option play. July, 90, 95, 100, 105 call condor. It sounds complicated, but you're buying the 90, 95 call vertical.
And it is.
It's not. You're buying the 90-95 call spread and financing it by selling the 100-105 call spread. Right now, you can do that for $3.30. It's a 4-day play. If the stock should stay between 95 and 100, you'll realize a $1.70 profit. Furthermore, if the stock should stay between 93.30, 101.70, you'll still make a little bit of money. Options are implying right now a 2 to 3% move in the stock. I really believe it's going to go nowhere fast right now. It's a great play.
Okay, nowhere fast. That much I understand. But let me ask you this. Why would you spend roughly $3.70 to make roughly $1, what, 30?
Yeah.
I mean, that's like why would you spend $1 to make maybe 50 cents?
Yeah. That's a good point. That's because volatility is so low right now, and the options are implying that nothing's going to happen to the stock. So right now, you're outlaying $3.30 to make $1.70 over 4 days. Now, obviously, if the earnings come out anywhere close to where they're expected, you're going to clean up on that position right away. But the reason why you're spending so much is intuitive. The stock's not going anywhere, and the market knows it.
All right, good.